Imagine one of the most protected, wide-moat compounders in the entire global financial system just suddenly plummeting before the market even opens. Not because the core business broke, not because customers fled, but because an automated news feed quite literally misread the math. Today, we're dissecting the exact anatomy of a glaring algorithmic pricing disconnect that hit S&P Global. We're going to uncover what the machines missed, what the underlying economics actually look like, where this business could be in 5 years, and arguably most importantly, what those expected future economics might actually be worth today.
So let's set the scene here. On the morning of July 28, 2026, S&P Global reported its second quarter earnings, and almost instantly, the stock took a 5.2% dive in pre-market trading. Now, a 5.2% drop for a company of this sheer size and quality, that's a massive, sudden repricing. It immediately signals to the market that something in the foundational thesis must have cracked. But when analysts and institutional investors actually opened up the filings to look under the hood, they found a completely different reality.
This brilliantly illustrates exactly what went wrong. To understand the error, you really have to look at how Wall Street's automated feeds process data. Just a few weeks prior, on July 1, 2026, S&P Global completed this major strategic move. They spun off their automotive-focused mobility division into a totally separate publicly traded company. Because of this, the earnings had to be reported on a pro forma basis, which basically just means excluding the mobility division to show what the continuing standalone business looks like. While the algorithmic news scrapers, they blindly grabbed the new pro forma GAAP earnings per share $4.08 and compared it directly against the adjusted analyst consensus of $4.75 or $4.95. The problem? That consensus largely hadn't been updated to reflect the recast base. They literally compared apples to oranges. The machine screamed massive earnings miss and triggered a sell-off. But the reality on the ground? S&P's actual pro forma adjusted EPS was $4.83. It was a clear, decisive earnings beat.
To see why this matters so much, we have to look at the underlying business. By getting rid of that lower margin, more capital-intensive mobility unit, S&P Global completely transformed itself into a pure-play, capital-light financial intelligence engine. If you look at their 2025 recast revenue, they now operate 4 highly integrated divisions. You've got ratings pulling in $5.07 billion, market intelligence at $4.85 billion, energy, which houses those famous Platts commodity assessments, at $2.59 billion, and indices at $2.1 billion. Look, this isn't just a random collection of data businesses. This is literally the central nervous system of global capital markets.
But to understand why this company commands such a premium valuation in the first place, we have to talk about the economic moat. The crucial point here is just how functionally locked in their institutional clients are. First up, you have regulatory anchoring. S&P Ratings is a nationally recognized statistical rating organization, or NRSRO. Global banking regulations literally mandate that institutions hold capital reserves aligned with credit ratings from an NRSRO. They are legally embedded into financial compliance. Second, the switching costs are incredibly high. S&P's market intelligence data is hardwired into the daily quantitative models and risk engines of major investment banks. Unplugging that risks catastrophic workflow disruption, which is exactly why their customer retention stays above 95%. Third, you have the S&P 500 network effect. As S&P 500 derivatives become more liquid, more asset managers are forced to use the benchmark, which just reinforces its absolute dominance. And finally, you just can't recreate over a century of irreplaceable brand equity.
So back to our story. The algorithms saw a miss, but when we actually look at the Q2 2026 pro forma results, the evidence paints a completely different picture. That 4.83 adjusted EPS wasn't just a beat against Wall Street estimates. It represented a massive 23% year-over-year increase. Let that sink in for a second. We're talking about a mature $100 billion enterprise growing its bottom line by 23%. The core economic engine wasn't stalling out, it was actively accelerating.
And let's see how this builds into their profitability architecture, because honestly, this is where S&P Global truly separates itself from almost any other business on Earth. Just look at these adjusted operating margins from Q2 2026. The Indices division operates at a staggering 71.5% margin. The Ratings division operates at 68.5%. Together, these two asset-light benchmark divisions generate roughly 63% of the company's adjusted operating profit. Think about it. When you charge licensing fees based on a percentage of global assets under management, or you charge basis points on massive corporate debt issuance, your incremental cost of delivering that service is practically zero. That is raw, unadulterated pricing power. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
When you take a step back and synthesize all of these factors into a qualitative scorecard, the picture becomes incredibly clear. The structural quality of this franchise is just elite. We're looking at a blended score of 9.0 out of 10. Profitability and track record both score perfect 10s. Why? Well, because the company converts nearly 100% of its operating earnings straight into free cash flow. They only require about $200 million a year in capital expenditures. That pristine cash conversion has allowed them to increase their dividend for 53 consecutive years. 53! Revenue quality sits at a 9 out of 10 because divisions like market intelligence and energy generate over 90% of their revenue from highly predictable recurring subscriptions. Ultimately, this is a fortress balance sheet funding aggressive capital return.
Now, all of the research behind this video was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems for under-the-radar names with asymmetric upside; and dividend hunters for durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes, and Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 1. 5-year scenario analysis. What could this business be worth in 2031? Before we jump into the numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
Okay, here's how those operational realities break down into a 5-year framework. In our base case, we assume S&P just executes on its medium-term targets. We're modeling a 6.5% revenue compound annual growth rate, which brings revenue to $19.91 billion by year 5. We also factor in their massive $7 billion share buyback they did in 2026, which drops the share count down to 250 million. If we apply a normalized 25 times PE multiple, which is historically standard for a financial infrastructure provider like this, we get a projected price of $637 per share. Now, the high case models what happens if there's an accelerated corporate debt refinancing cycle and they successfully monetize their new Kensho AI tools. In this scenario, they're out there charging 35% to 45% premiums on contract renewals just for AI integration. Revenue grows at 8.5%, margins hit 56%, and if the market slaps a 28 times multiple on that, we get to an $882 share price. But, we also have to look at the low case. What if interest rates stay high, totally choking off corporate debt issuance, and clients push back hard on software pricing? In that world, revenue growth slows to 3.5%, margins contract, the multiple compresses to 18 times, and we land at a $333 share price.
When you apply probability weightings to these scenarios, so let's assign a 65% probability to the base case, 20% to the high case, and 15% to the low case, the weighted expected future share price lands right at $639.75 in year 5. Against the current price at the time of this research, that implies a highly attractive 9.4% annualized return. That's essentially what the market believes this compounding engine can deliver if management simply executes its operating targets. But remember, this answers what the stock might trade for in the future. So now we have 3 possible destinations 5 years from today. But there's another question, and arguably an even more fundamental one. What are the cash flows this business could generate actually worth right now?
Section 2. Discounted cash flow analysis. What are expected future economics worth today?
All right, so what is the present value of this operating engine? S&P Global's business model is incredibly clean for a discounted cash flow, or DCF, analysis. Because of their recurring subscriptions and super low capital expenditures, their free cash flows are highly visible. Anchoring back to our base case of a 6.5% initial revenue growth rate, we project this out 10 years. As revenue scales up and operating margins expand slightly due to those AI productivity gains we talked about, the absolute tidal wave of cash becomes apparent. Unlevered free cash flow starts at $7.2 billion in year 1, climbs to $9.2 billion by year 5, and reaches a massive $11.2 billion by year 10. The trajectory is just remarkably consistent.
So now we build the valuation bridge intuitively. Step 1, we have to discount those 10 years of explicit cash flows back to today's value, because $1 tomorrow is worth less than $1 today. The hurdle rate we use to account for time and risk is the weighted average cost of capital, or WACC. For S&P, given their highly diversified and resilient beta of exactly 1.0, that discount rate sits at 8.5%. Step 2,
Obviously, the company doesn't just vanish in year 11, right? So we calculate a terminal value using a 3.0% perpetual growth rate, which represents steady GDP plus global economic expansion forever. Step 3. We take that total enterprise value, add the $4.1 billion in cash they have sitting on the balance sheet, and subtract their $15.17 billion in debt and other senior claims. Step 4. Finally, we divide that remaining equity value by their 294.8 million outstanding shares.
And that brings us to a central intrinsic value estimate of $458.28 per share. But listen, valuation is never about false precision. It is always about probability ranges. This sensitivity matrix shows exactly how fragile or robust that $458 number actually is. If macroeconomic conditions shift, say the discount rate drops to 8.0% and terminal growth bumps up to 3.5%, the intrinsic value shoots up to $548. Conversely, if risk premiums rise, pushing WAKE up to 9.0%, with lower terminal growth, the value compresses to around $371. The crucial takeaway here is that the reasonable, mathematically sound intrinsic value range sits somewhere between $365 and $585.
Now let's compare that present intrinsic value to the actual market reality. As of August 7th, 2026, following that algorithmic sell-off we discussed at the very beginning, S&P Global's shares settled at $408.19. When you place that against our base present intrinsic value of $458.28, the market is offering this stock at a roughly 10.9% discount to its fundamental base value. Basically, the market price right now suggests either a much higher discount rate or much lower terminal growth than the business's historical resilience would typically ever justify.
So, do these two independent valuation lenses, the 5-year scenario analysis and the DCF, actually tell the same economic story? Yes, they align perfectly. A lot of investors get pretty confused here. They see a present value of $458 and a future price target of $637, and they think, wait, there's a conflict. There isn't. The DCF tells us what the business is fundamentally worth today based on future cash flows discounted backward. The 5-year scenario tells us what the stock price will actually read on a screen 5 years from now if the business executes and the market applies a normal 25 times multiple. A $458 present value compounding at about 9.3% annually naturally grows right into that $637 future price. It is the exact same story of steady, resilient value creation, just told from two different angles.
Section 3, the risk framework. What could break the compounding thesis?
Because understanding the upside targets just isn't enough. We really have to look at the risks that could actually break this compounding machine. The most immediate macro risk is a prolonged high interest rate environment. Ratings volume relies heavily on corporate debt refinancing. If rates stay elevated and companies just refuse to issue debt, transaction fees plummet. That's your early warning sign. Watch for consecutive quarters of declining billed corporate debt issuance. Second is technology execution. S&P is baking a whole lot of growth into their Kensho AI pricing. If corporate clients scrutinize their software budgets and refuse those 35% premium renewals, the margin expansion we modeled in the DCF just evaporates. Third is the competitive threat of what's called direct indexing. If giants like Vanguard or BlackRock bypass index licensing to create customized, zero-cost internal benchmarks, S&P's incredibly lucrative ETF royalties take a structural hit. And finally, the ultimate tail risk, regulation. If global authorities ever revise the rules so that financial institutions are no longer legally required to use NRSRO-rated debt, S&P's regulatory moat vanishes literally overnight.
So what is the ultimate business truth here? We started this explainer by looking at a glaring algorithmic error, a 5.2% sell-off, triggered by machines blindly comparing a pro forma gap number against an adjusted consensus. What that error did was temporarily misprice a highly resilient, wide-moat asset. The underlying fundamentals tell us that S&P Global successfully spun off a lower-margin division to become a pure-play compounding machine. Their core ratings and indexing divisions boast near 70% operating margins. They are successfully integrating and monetizing generative AI. And whether you look at the 5-year operating framework pointing to a mid-$600 future price, or the DCF highlighting a present intrinsic value near $458, both lenses reveal a high-quality franchise trading at a discount. The variable to watch next is simply how smoothly they navigate the upcoming corporate refinancing cycle and how well they defend those AI price bumps.
The automated machines panicked over a formatting change, but the math reveals a compounding engine trading at a rare discount. The real question isn't whether the algorithm was wrong today. It's whether you're willing to trust the intrinsic value when the rest of the market is blindly reading the headlines. If you want the full research, including the complete 5-year scenario model and intrinsic value analysis behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.